After studying this module, you shall be able to learn about the fixed and floating exchange rate system, evaluate crawling peg, know about the current account convertibility, understand the government interventions, sterilization and non-sterilization. Introduction. Financial deregulation is said to take place when there is reduction or simplification in the rules and regulations governing the financial system. Deregulation amounts to reduction in the government's role in controlling and regulating the financial markets and institutions. Deregulation is designed to increase the efficiency of markets by letting the market forces guide the economy. In this module, we will throw light on financial deregulation in context of the exchange rate system. After the Second World War, the fixed exchange rate system was prevalent whereby a currency's value was fixed against the value of US dollar. This system collapsed in 1973, after which the flexible exchange rate system replaced the fixed exchange rate system. Fixed exchange rate system. In July 1944, while the Second World War was still going on, the representatives of 44 nation states met at Bretton Woods, New Hampshire, to design a new international monetary system. An agreement was reached to establish two multinational institutions, IMF, that is International Monetary Fund, to monitor the international monetary system, maintain exchange rate stability and oversee national monetary policies, and also provide financial assistance to the member countries for meeting short-term balance of payment deficit. IBRD, known as International Bank for Reconstruction and Development, was established to primarily finance the post-war reconstruction of the member countries. After the end of the Second World War, US was holding about 74% of the world's gold stock and accounted for about half of the world's real GNP. So, under the Bretton Woods or fixed exchange rate system, each country agreed to fix the par value of its currency in relation to the US dollar. This par value determined the exchange rate between different currencies. The US dollar was in turn pegged to gold at $35 per ounce. US dollar was the main reserve currency held by the central banks and the only currency that was directly convertible to gold. Each country was required to maintain the market value of its currency within plus minus 1% of its adopted par value by buying or selling the foreign exchange as necessary. However, the member countries were allowed to alter the par value of its currency if it faced fundamental disequilibrium. If it faced fundamental disequilibrium in the balance of payments. For changes up to 10%, IMF approval was not required, but for changes beyond 10%, IMF approval was necessary. This system was addressed with different names such as fixed parity system, par value system, pegged exchange rate system and dollar-based gold exchange standard. Collapse of fixed exchange rate system. During 1960s, US undertook the welfare programs. The increased government expenditure was financed by increasing the domestic money supply, which led to inflation. With increased money supply, people started spending more. Consequently, the demand for imports increased while exports became uncompetitive due to the increased prices of the US goods. Thus, US balance of payment swung into deficit. The member countries began to lose confidence in dollar and started converting their dollar reserves into gold. The gold stock with US Treasury began to fall drastically. To supplement the existing reserves and to reduce the pressure on dollar, the IMF in 1970 also created international reserve assets called as SDR, that is special drawing rights, which could be used by the countries for making payments internationally. The SDRs were allocated to all the member countries in proportion to their quotas. All the attempts to solve the disparities failed. US balance of payment continued to deteriorate. The dollar stood overvalued against German mark and Japanese yen, because of which the German and Japanese central banks had to make massive interventions in the foreign exchange market to maintain their par values. As a result of all this, in August 1971, the then US President Richard Nixon suspended the convertibility of dollar into gold and also levied a surcharge of 10% on imports until the revaluation of other currencies against dollar. This shook the foundation of Bretton Woods system. In order to save and restore Bretton Woods system, in December 1971, a conference was held at Smithsonian Institute at Washington, D.C. They reached an agreement to make the following changes. Change in the parity value of gold from $35 per ounce to gold $38 per ounce. Other major currencies were revalued upward against US dollar. The band for fluctuation from par value was widened from plus minus 1% to plus minus 2.25%. The Smithsonian Agreement could not go far as the devaluation of dollar was not enough to stabilize the situation. In February 1973, the parity value of dollar was again revised upward from $38 per ounce to $42 per ounce. By March 1973, the major currencies were allowed to float and the fixed exchange rate system came to an end. Next is flexible exchange rate system. After the collapse of fixed exchange rate system, the flexible exchange rate system came into scene in 1973 and many leading industrialized nations started adopting it. IMF constituted a committee to evolve a new international monetary system. The committee members came out with a new set of rules which were formally accepted by all member countries in a meeting at Jamaica in January 1976. With this came the system of flexible exchange rates, where the exchange rate is not fixed by the government authorities, rather it is determined by the market forces of demand and supply of the currencies in the international market. If in an economy the demand for a particular foreign currency increases, then the price of this currency in terms of domestic currency will shoot up. This in turn will lead to depreciation in the domestic currency and appreciation in the foreign currency in the domestic economy. The demand for foreign currency arises from the demand for imports in the domestic economy, and the supply of foreign currency comes from the export by the domestic economy. The supply of foreign currency increases only when there is an increase in the demand for exports from the domestic economy. No country has adopted freely flexible exchange rates. Most economies have adopted a combination of pegged and flexible exchange rate. The flexible exchange rate existing today differ only in terms of degree of intervention by the government. This system is called the crawling peg system. Key benefit of flexible exchange rate system. The key benefit of flexible exchange rate system is automatic external adjustment and national policy autonomy. With fixed exchange rate system, the government has to devise the necessary fiscal and monetary policies to correct the balance of payment disequilibrium at the existing exchange rate. So, government will remain occupied in maintaining the exchange rate and will not be able to address the other important economic objectives. So, the government loses its policy autonomy. But external balances will be achieved automatically as long as the exchange rate is determined by the market forces of demand and supply. As a result, there will be no need for the government to take any policy actions to correct the disequilibrium in the balance of payment. So, the government will be able to use its fiscal and monetary policy to pursue other economic goals and objectives. Fixed versus flexible exchange rate system. In fixed exchange rate regime, the exchange rate is determined by the government, whereas in flexible exchange rate system, the exchange rate is determined by the market forces of demand and supply. In fixed exchange rate system, the exchange rates are periodically adjusted by the government to keep them in line with the changing macroeconomic variables like inflation, whereas in flexible exchange rate regime, the exchange rate adjusts automatically to the changes in the market factors. In fixed exchange rate system, the government needs to keep large amount of reserves to maintain the exchange rate at the desired level, whereas in flexible exchange rate, there is no such requirement. In fixed exchange rate system, the exchange rates are fixed and stable but may lead to market distortions in the long run. On the other hand, in flexible exchange rate regime, exchange rates fluctuate but remain stable around the equilibrium in the long run. Crawling peg system. This system is a hybrid of fixed and floating exchange rate system and is an automatic system for revising the exchange rate. Under this system, the country establishes the par value of its currency in relation to a foreign currency and then allows the par value to vary within a given percentage to move in line with the changes in the factors like inflation. Once the par value is set, the central bank intervenes whenever the market value approaches the limit point. Suppose, for example, the par value of Saudi Arabian Riyal is SAR 10 for 1 USD and is allowed to vary plus or minus 3% around this rate between SAR 10.3 and 9.7. So, if the dollar approaches the rate SAR 10.3, the Saudi Arabian Central Bank will intervene by buying Riyal and selling dollars. Similarly, if the dollar approaches SAR 9.7, then the central bank will intervene by selling Riyal and buying dollars. If it lingers around a limit point too long, causing the central bank to intervene frequently, a new par value is established closer to this point. Suppose, for example, the dollar was lingering around SAR 9.7 for a long time, then the Saudi Arabian government will establish the new par value at SAR 9.7. A country can either peg its currency to a single currency or to a basket of currencies. Countries like Jordan, Bahamas, Iraq, Lebanon, Maldives, Saudi Arabia and Qatar have pegged their currencies to a single currency. Countries like Fiji, Libya and Morocco have pegged their currencies to a basket of currencies. Advantages of crawling peg system. This system offers two main advantages. First, this system helps to avert the economic instability that arises due to the adjustment process associated with fixed exchange rate system. Second, it helps to reduce the uncertainty that arises due to the volatility associated with flexible exchange rate system. Next is current account convertibility. Convertibility means the reduction or removal of restrictions and control on currency transactions. It refers to the freedom or the ability of both the residents and non-residents to exchange the domestic currency for foreign currency and vice versa without any limit for all types of transactions. Here, a distinction must be made between current account convertibility and capital account convertibility. Current account convertibility implies freedom in respect of transfers and payments for current international transactions. In simple words, both the residents and non-residents can exchange the domestic currency for foreign currency and vice versa for purchasing goods and services from abroad. Capital account convertibility, on the other hand, implies the movement of currency in and out of country in relation to capital transaction as well without any restrictions. It means that besides the freedom to purchase goods and services abroad, the currency can also be converted for purchasing assets abroad. In India, a system of partial rupee convertibility was introduced in 1992, where rupee was made convertible on the current account. It was designed to give boost to exports, and it allowed the residents to make and receive trade related payments, that is, receive the foreign currency for exporting goods and services and paying foreign currency for importing goods and services, as well as for travel, education, medical treatment abroad. However, India also has some elements of capital account convertibility in the sense that foreign investors can invest the funds and can take them out for both direct investment and portfolio investment subject to limits. Similarly, Indian residents can also invest in foreign financial assets subject to certain limits. In economies like USA, Switzerland and Canada, the policy framework governing capital flows were liberal from the very beginning of 1950s. In case of some economies, capital account convertibility could not be sustained for long. For instance, Portugal and Spain reimposed the controls on movement of capital in 1992. In 1980, many of the developing nations went for full capital account convertibility in order to attract foreign investment, not realizing that free movement of capital opens the economy to both sudden and huge inflows as well as outflows, both of which can have potentially destabilizing effects on the economy. However, the experiences of developing economies differ. For instance, in Venezuela, capital account convertibility could not succeed, whereas in Argentina, there was an improvement in the balance of payments following the introduction of capital account convertibility. Drawing from the experiences of both the developing and developed nations, many researchers have advocated that some preconditions must be fulfilled before introducing full convertibility, and moreover there should be proper sequencing. The changes should be introduced gradually and in a phased manner. It means that current account convertibility should precede the capital account convertibility. Government intervention. The central banks often intervene in the foreign exchange market to influence the level of exchange rate. The intervention can be direct and indirect as well as sterlized and non-sterlized. Direct and indirect intervention. A country's monetary authority often intervene directly or indirectly to stabilize the exchange rate and to keep it within the desired limits. It is also known as dirty floating. In case of direct intervention, the monetary authorities attempt to stabilize the exchange rate by buying and selling foreign currency in the domestic market. When it buys foreign currency, its demands increases and the domestic currency depreciates against the foreign currency. When it sells the foreign currency, its supply increases and the domestic currency appreciates against the foreign currency. In case of indirect intervention, the monetary authority brings changes in the interest rate to stabilize the exchange rate and to flush out the excess volatility. Some of the countries which are following this system are India, Russia, Egypt, Singapore, Thailand and Czech Republic. Sterlized and non-sterlized intervention. Sterlized intervention is said to take place when an action is taken simultaneously in the money or good market in order to combat the undesired effects of an action taken in the foreign exchange market. Suppose, for example, the dollar was depreciating against rupee. So to establish the price of dollar in Indian foreign exchange market, the monetary authority intervened in the foreign exchange market and starts to purchase dollar. With the purchase of dollars, the money supply in the domestic economy increases, which may lead to inflation. To prevent this from happening, the monetary authority will either introduce credit controls or will sell its securities in the market to absorb the excess money supply. This is known as sterlized intervention. Non-sterlized intervention is said to take place when the monetary authorities does not take any action to absorb the excess money supply generated by the purchase of dollars and lets the money supply increase. Let us now summarize what we have done in this module. Financial deregulation is said to take place when there is reduction or simplification in the rules and regulations governing the financial systems. This module in particular talks about the financial deregulation in context of the exchange rate system. After the Second World War, the fixed exchange system was prevalent, whereby a currency's value was fixed against the value of US dollar. This system collapsed in 1973, after which the flexible exchange rate system replaced the fixed exchange rate system. The fixed exchange rate system was established in 1944. The agreement also established two multilateral institutions, namely IMF and IBRD. Under this system, US dollar was the reserve currency and the only currency convertible into gold. All other countries were required to fix the par value of its currency in terms of dollar. A fluctuation band of plus minus 1% was established. However, for significant changes in the par value, IMF approval was necessary. In 1960s, the US experienced severe balance of payment deficit, due to which US dollar stood overvalued. Attempts were made to prevent the collapse of the fixed exchange rate system in the Smithsonian arrangement. But the arrangement could not go on long and the system finally collapsed in 1973. The flexible exchange rate system came into scene in 1973 and many leading industrialized nations started adopting it. In this system, the exchange rate is not fixed by the government authorities, rather it is determined by the market forces of demand and supply of currencies in the international market. No country has adopted freely flexible exchange rates. Most economies have adopted a combination of pegged and flexible exchange rate. The flexible exchange rate existing today differ only in terms of degree of intervention by the government. This system is also known as the crawling peg system. Fixed exchange rate system differs from flexible exchange rate system on several counts like determination, adjustment of balance of payment deficit and requirement to hold reserves. Crawling peg system is a hybrid of fixed and floating exchange rate system. Under this system, the country establishes the par value of its currency in relation to a foreign currency and then allows the par value to vary within a given percentage. A country can either peg its currency to a single currency or to a basket of currencies. Convertibility means the reduction or removal of restrictions and controls on currency transactions. It refers to the freedom or the ability of both the residents and non-residents to exchange the domestic currency for foreign currency and vice versa without any limit for all types of transactions. Convertibility is of two types: current account convertibility and capital account convertibility. Current account convertibility implies freedom in respect of transfers and payments for the current international transactions, whereas capital account convertibility implies movement of currency in and out of country in relation to the capital transactions as well without any restrictions. Government intervenes in the foreign exchange market from time to time to influence the level of exchange rate. The intervention can be direct or indirect as well as sterlized and non-sterlized.